Hey everyone, welcome to the channel. So today we're going to look at the price to earnings ratio, or PE ratio. In the next few minutes I'm going to talk you through a few definitions, show you the calculations you need, and explain how you can use ratio analysis. The price to earnings ratio, or PE ratio, is the ratio for valuing a company that measures its current share price relative to its earnings per share, or EPS. The price to earnings ratio is also sometimes known as the price multiple or earnings multiple. The EPS is the profit attributable to shareholders as shown in the income statement divided by the number of shares in issue. Now you know what PE is. Why is it actually useful? It shows you the price you pay for what the company earns, effectively showing you your value for money, and it tells you a little bit what the market sees as the prospects of the company. Before we get into this in more detail, let's look at a few calculations. To calculate the PE ratio or the EPS, you'll need the current share price and the earnings for the period you want to measure. You can find the share price easily online. You can even Google the company name and it will show you the share price. For the earnings, you'll need to go into the company's financial statements and take a look for earnings attributable to the shareholders. The price to earnings ratio is simply the current market price of the share divided by the last year's earnings per share. To calculate this earnings per share figure, we simply divide the total earnings figure by the total number of shares outstanding. The period of time is important when calculating the PE ratio, as you can take earnings from the last year for current PE, or you can look at the predicted earnings for next year to calculate the future PE, and historical averages to work out if the current ratio is above or below historic levels. It's important to note here that if you're aiming to look at the historic ratios, you need to take the share price for the period you're looking at. For example, if you're looking at a 5-year average, you'll need to take the average share price over that period along with the average EPS. One thing you can also do with this equation is flip it upside down. If we instead divide the earnings per share by the current share price, we can then get the earnings yield. You can use these formulas for any example, just plug in the numbers and you'll get the correct value. Remembering back to the start of the video when we said that the PE ratio shows you your value for money in the price that you pay for the stock. The key idea to remember when you're assessing PE ratios is that it's all relative. You can use PE ratios as a comparator to other companies of similar size, to the industry or as a whole, or to the firm's own historical averages. If the PE ratio for the firm is less than the historical levels, or the competitor or the industry, you're getting a discount. But remember, there might be a reason for the company being relatively cheaper than the market or its history or competitors. Another way we can look at the PE ratio is to consider if it's a value company or a growth company. A high PE ratio means investors are willing to pay a higher price right now for smaller earnings because they believe the company will grow quickly in the future. A lower PE ratio can mean that investors believe the company will not grow as quickly in the future, which could be for a variety of reasons and would therefore be a value company. The important thing to remember about the PE ratio is that it is only one of many metrics. Definitely learn about it and consider it, but remember to always seek out more information. In this video, we've learned that PE compares a company's share price with its earnings. PE is measured by dividing the price per share by the earnings per share, and PE can be used for comparison and understanding the type of company. Thank you for watching the video. Please like, subscribe, and let us know of any other topics you'd like us to cover in the comment section below.